Hi, I'm Debbie from Property Apprentice. Thank you for joining me for today's bonus podcast, which is Where are interest rates going and how to deal with rate hikes. Among force majeures in recent history, the COVID-19 pandemic is a unique event that not only tested the resilience of New Zealand's healthcare system, but also provided challenges to our economy. In the beginning, you might recall that the government decided to lower interest rates to ease the financial strain on businesses and homeowners struggling to keep up with mortgage repayments and debt servicing costs. Lower interest rates also serve the purpose of keeping the economy afloat by encouraging consumers to spend. Many Kiwis saw this as a good opportunity to buy property as low rates meant servicing a mortgage was more affordable. Strong demand and the fear of missing out, or FOMO, caused house prices to rise steeply, especially with the combination of rising interest rates for the first time since 2017 and the amendments to the CCCFA, which is the Credit Contracts and Consumer Finance Act, which resulted in tighter lending criteria that made it more difficult to get a mortgage approved, which literally put fuel on the fire of FOMO, causing a massive spike in nationwide median prices between September 2021 and the end of November 2021. Coupled with offshore inflation pressures, such as fuel prices and the war in Ukraine, you can probably guess what happened. Annual inflation rose to around 7%, which is way beyond the 1 to 3% target rate of inflation. The Reserve Bank began to hike the official cash rate again, the OCR, in order to curb high levels of inflation. This, to stricter lending conditions and increased housing stock, caused house prices to fall significantly. But to keep it in perspective, only back to about where prices were in mid 2021. We're still in this period of rising interest rates. While most predictions point to an upward trend, especially with the floating interest rate, there's no accurate way of telling how high it might rise. In fact, we've recently seen long term interest rates starting to decrease. However, as long as inflation's not under control, we are likely to see some more OCR hikes, which, as I mentioned earlier, will have the biggest impact on the floating interest rates and potentially some of the short term interest rates. If your fixed rate mortgage is due to come off soon, I can totally understand why you might be having cold feet about this. New interest rates might be more than double what you're currently paying, and choosing the wrong structure for your mortgage could be something you truly want to avoid. The best thing you can do is to become proactive and get professional mortgage advice. This isn't a sales pitch. The reason we strongly advocate that borrowers consult with an advisor when it comes to getting a new mortgage, refixing, or refinancing is that each person has their own unique situation. It's not always as simple as choosing the lowest mortgage rate. As a matter of fact, a better guideline for you is to look at your own personal circumstance and examine your tolerance for risk. And then having a professional mortgage advisor to help you through this process is invaluable. First, ask yourself if you're ready to absorb a sudden increase in interest rate. This has become the norm, and many people are happy to pay extra for a longer term rate because it means they can stick to a budget better rather than worry about rate hikes being reported in the news. Second, be sure to look ahead when a rate ends. The rates following a fixed term rate are as important as the initial rate. A low 1 year rate might mean that you pay less for the first year, but if the new 1 year rate is much higher when it comes time to refixing, then it might be better to look for some other options, especially if your budget is a major concern for you. Third, it might be worth taking into consideration your ability to make lump sum repayments. This is useful if you're expecting to receive an inheritance or a pay rise, or if you're on a fixed rate and plan to make a lump sum payment, you might need to make an early repayment penalty fee. In order to avoid this, you can wait until your mortgage is briefly on a floating rate at the end of your fixed term before you make that lump sum payment. Fourth, you might want to split your mortgage to lower your risk. Many people split their borrowing across different rates with different expiry dates in order to avoid having their entire mortgage on one unfavorable fixed rate term. Some keep floating rates to allow for lump sum repayment without penalties. Just bear in mind that the floating interest rate at the moment is likely to be much higher than any of the fixed rates that are on offer. Fifth and finally, you'll benefit from working with an experienced mortgage advisor, especially when it comes to deciding what rate works best for you. There's no cost in engaging with an independent mortgage advisor because they're paid a commission by the lender that you decide to borrow from. And in many cases, mortgage advisors know which bank is best for your suitable situation. So what they'll do is they'll have a look at all of the different options that are available and help you out to get your best possible outcome. And the mortgage advisors that we recommend at MITeam, which is miteam.co.nz. So feel free to get in touch with them through the website or give them a call on their 0800 number. We'll put the contact details in the show notes as well for you. Thanks for listening.